All right, so quickly, does everybody see, I will need someone to jump in the chat, does everyone see the creative financing slide that's all black, has Warriors of Wealth and says creative financing on it? I want to make sure that that what I see is what you guys see. Yes, okay, awesome, you guys, thank you so much. All right, let's get started. All right. My name is Stacy Conkey. I am going to be your presenter today. Welcome to the Warriors of Wealth Real Estate Investing Coaching Program. Today we're doing a free training on creative financing. And if you guys are in our Facebook group already, because I know some people who are here are, and some are just got an email. But if you're in our Facebook group, you probably saw a poll last week where we were asking, what are some topics that you would like to get some trainings on that we haven't done before? And this is the one that everybody voted for. So here we are. So Jennifer and I have been investing since 2003. This is just to give you a little bit of background on who it is that's teaching you. So, just that you know, I'm not just making stuff up. We've been around a little bit. We have been in 14 different markets across the U.S. All of our investing is done remotely. So Jen and I live in San Diego, California, and we invest pretty much everywhere but here. The numbers here just don't work. Definitely not for passive income. So we are very accustomed to, we just work from home or from our laptop, wherever our laptop is. If the laptop is with us sitting in the driveway or our kids are riding their bikes, then that's where we're working. If we're in the Bahamas and, well, we're in between doing things, then that's where it is. If we're just sitting in our office, that's where it is. So we do everything remotely, which is different than the way that a lot of people do or teach real estate. So that is something it's important to know, because anytime I'm teaching or talking to you, you should know that I'm never talking about you going and physically doing any of the things that we're talking about. It's always about leading a team. Jen was a leader in corporate America for over 22 years. So she has a tremendous amount of leadership experience. The last thing she did in corporate America before leaving 5 years ago was she ran a 1 million square foot distribution facility for Home Depot, and she had over 700 employees. So she's highly, highly skilled in leadership department, which is obviously helpful when you're, leading teams. My background was accounting many, many years ago, but I've been coaching new investors for the past 10 years and obviously doing all of our own real estate investing. So we bring a lot of experience to the table, and we just truly, truly have a passion for helping new people get to the next level, whatever that next level is. Sometimes it's just you doing your first deal. And then sometimes it's you going from, 2 to 4 family and going into apartments. But that's our passion, is giving the education and the supportive environment to help you actually start taking the actions that you want to take to reach whatever goals you have. So Jennifer and I combined our skills to create Warriors of Wealth, real estate investing coaching, and our mastermind. So sometimes you'll hear us talking about the mastermind, or you'll see us post something on Facebook or LinkedIn about it. That's our group of investors who've decided to invest in their knowledge and their education, and we work with them on a weekly basis and basically holding their hand through the journey. So anyway, that's pretty cool. We love doing it, and we're happy to be here with you and feel like it's an honor and a privilege for you to trust us with your time. And we're going to honor that and just give you some fantastic content today. So let's get into it. All right. So with creative financing, it really is, it's more of a technique. It's more of a mindset than a specific technique. And I've always maintained that. So creative financing is more of a mindset than any specific technique. That being said, it's helpful if you know what's possible, so that when you identify an opportunity to put a deal together, but you don't necessarily have all the funds, you know what your options are to piece that puppy together. All right. But the mindset of creative financing is more that, you know what, I found a good deal, and okay, maybe I don't have all the funds, but what do I need to do to pull this thing together? So it really starts from a place of a decision to go after something. And I'm going to teach you today. So that is not something I could do for you. That has to come from within. Your desire, your want for it has to be greater than all of the obstacles that will come, because this is real estate investing. And as much as there's some gurus out there that talk about how easy it is, there is nothing easy about real estate investing. It's challenging, but it's very well paid, and it sets you up for your future. So to me, it's not easy, but it certainly is worth it. And I want to give you all the tools that you can use to get through those stumbling blocks, give you some ideas. But at the end of the day, when it comes time to do a deal, you just got to dig deep And eventually you get used to doing that. You got to get deep and just have the resolve. I'm going to pull this thing together. All right. So a lot of times when people are talking about creative financing, they're talking about focusing on pre-foreclosure and other highly motivated seller situations. So in this case, I'll identify which strategies are more popular in that arena, but those are also strategies that are typically done in your home market. And in my experiences, require an incredible amount of time and money to find, and the competition is fierce. So I'm never going to tell you, you should not do real estate in your home market. If you happen to live someplace where the numbers make sense, cool, then go ahead and invest there. However, most of our students that we have, and people are all over the US, they don't necessarily live in a place where the real estate strategy lines up with the prices or the population growth or the job security in that market. So I want to teach you, even if you do live in a good market, I want to teach you how to look at things from the standpoint of, it doesn't matter where I physically am versus where the market physically is, we're still going to do this. So the thing about pre-foreclosures is that is a strategy, and I'm going to back up a little bit because I realize not everyone necessarily knows what I mean by that. A pre-foreclosure is when someone has started falling behind on their payments. And there's a lot of gurus out there that teach the strategy of going after those. And so, for one, there's just a lot of competition because of that. So you have everybody and their brother who've been through whatever course it was that was teaching that. A lot of courses teach that are sending letters to the sellers, phone calling them or calling them on the phone, skip tracing, going and knocking on their door. So the sellers in this case are just getting inundated with investors who are like, hey, I'll buy your house. And so at one point that was a great strategy because there wasn't a lot of people doing it. But eventually when people started doing it more and more and teaching it more and more, it just became more difficult because you have a lot of competition. The other side of it is when you're sending letters and doing like yellow letter campaigns, it's just pricey. It's expensive to do that with not a lot of results. So that's not the way that we do it, but there is a certain strategy that does work really well when you're dealing with a motivated seller or a pre-foreclosure. So, but you never know. And sometimes you might be working in a market that's not in your area, and it wasn't a pre-foreclosure, but it is a motivated seller. So certain things that I teach you, even though they're really good for pre-foreclosures, you can definitely use it if you happen to come across a situation like that. So I'll get into that as well. Our style of doing real estate and what we focus on with our students in the mastermind is to leverage the time and energy of real estate agents in multiple markets. So building relationships where you stay top of mind. So that when a new property comes on the market or comes back on the market or is price reduced and it meets your criteria, they see it and they get it to you as soon as possible so that you can, boom, get your offer in quickly. Having multiple people who are full-time in real estate, it also benefits you because of the relationships they're building and the off-market deals that they end up getting and bringing to you. So we're going to talk about lots of different ways to finance deals and which ones are more prevalent in which situations. But the focus that we put on real estate and what I'll be talking more about is our style, which is leveraging the time of agents who are building relationships and getting a lot of deal flow coming in instead of us sending out a whole bunch of letters, knocking on a whole bunch of doors to maybe get 1 or 2 leads. All right, so let's start off by talking about the foundation, just the very foundation. The foundation of this is when you're looking at financing is what needs to be funded. All right, so we have obviously the purchase needs to be funded, renovations, closing costs, funding costs or financing costs, and impounds if performing. So what an impound is, let's say you're buying a cash flow property that has tenants in there already and you're getting a conventional loan. The lender is going to ask you to put up a certain number of months of reserves, not reserves, impounds. For example, they might say, okay, well, we want to have you put up 3 months of property taxes and 3 months of insurance. And every month when you're making your payment, you're also paying basically 1/12 of your annual property tax and 1/12 of your annual insurance so that they're building it up. So when those are due, your lender just pays it. You've been paying it all along 1 month at a time throughout the year. But it's very common that in the beginning, as part of your closing, you have to be able to come up with a few months of impounds. All right, so that is something to be aware of when you're moving forward. Is one of the things that can hang up a new investor. It certainly did me when I was new. I had no idea. Nobody ever broke it down for me this way. So I just really didn't know until I was in the situation what I what I needed. But if you don't know what's coming as far as the cash requirements, the day of closing or the couple days before closing, when you're trying to pull it all together, when you find out, well, shoot, I got to come up with another $5,000, that is stressful, like to no end. Like, it's so stressful, especially when you think you had all the money and all of a sudden you realize you're short by $5,000. So that's part of why I want to lay this foundation so that you can be prepared with what you need to pull together. Now, I'm not going to talk about specific amounts because it's going to change on every deal. But what I want you to do is, at a minimum, write down these 5 things, because these are the things that you need to research. Obviously, the purchase, you don't have to research because it's whatever your offer price was. And it's going to be whatever percentage of the purchase price your lender isn't providing, right? Your down payment. With the renovations, you need to get your contractors out there. With closing costs, you can call your title company and ask them. With funding costs, that's going to be information from your lender, and same with impounds. Okay, so these are the things that you need to be thinking about as you're, looking at a deal and putting everything together. All right, so a couple things before we really get into all the different kind of creative financing things. First of all, what is a performing property? All right, so a performing property is one where you already have rents coming in. All right, so you're probably going to get bank financing on that. The creative side of it, where the creative financing mindset has to come in with a performing property, is going to be the down payment that you need to come up with, and the other costs, the closing costs, the funding costs, etc. All right, so that's where that comes in. And when we get a little bit further down in the slides, I'm going to talk about what are some of the different sources that you can use to come up with those. All right. The other thing is seller financing, and that's what I wanted to kind of start introducing to you. So with seller financing, there's 3 different ways that you can create a seller finance situation. And it really depends on the seller's current loan situation. So if the seller has no loan in place, they can just carry a seller carried first. That means a seller carried first mortgage. They can also do a subject to existing mortgage, which I'll explain more, and then also a wraparound mortgage. All right. We will get into more details on all those, so don't worry. All right. The other thing is you can do the BRRR, which is buy, renovate, rent, and refinance, or let's say fix and flip, right? So we're either talking about buying a performing cash flow property or something that's going to have renovation involved, and then there's going to be either an end loan or a sale that would bring in money at the end of the deal. Okay. So with that, the primary way we would finance those would be through a hard money loan, right? The creative side, but again, there's no lender out there who's ever funding 100% of everything. And if you ever see an advertisement or anyone doing a post or anything saying we do 100%, just know, like, let your spidey senses be your guide. If you're like, that sounds too good to be true, you're correct. It is. There's no lender that does all of it. You're going to have some amount of money that you're bringing to the table. So if that's the case, that's where the creative side of it comes in. We were going to have potentially a down payment with the hard money lender, closing costs, holding costs, and financing costs. And the holding costs are things like the monthly payment to the hard money lender. So you're making a monthly interest payment. You probably aren't going to have to pay your property taxes on a monthly basis, because those usually just do it at a certain time of year, but it's important to be aware that they are accruing. And then also your insurance, which is typically paid in advance when you close the deal. All right, so hard money lender will fund the majority of it, and then the creative side is funding the rest, the down payment, all the other stuff. On the seller financing side, the creative part of it is, well, the seller financing itself, but in addition, if you're not using a hard money lender for the BRRR or flip, then you're going to be funding those rehab costs out of pocket. The hard money lender, they're typically lending you, let's say, and it changes lender by lender, but let's say they're lending 80% of the purchase price and 100% of the rehab funds. That means that you don't have to fund any of the rehab yourself. It's just coming right from the lender on a reimbursement basis. But if you're going to do seller financing with a property that needs to be fixed up, then you are going to have to bring other money to the table in order to do the project, right? You're going to have to bring the rehab costs, your closing costs, and your holding costs. Okay, so that's just something to be aware of. Even if you're doing seller financing, and if it's a BRRR or fix and flip, the creative side of it is there's still going to be other funds that we need to raise, and why you have to think outside the box. All right, so let's just talk a little bit more about seller financing, because seller financing, this is When you guys hear people talking about creative financing and they're talking about, talking to the sellers and doing motivated seller, this is pretty much the strategy they're talking about. It's seller financing. But there's three different ways, and within those three ways, there's 100 different ways, but there's three different main ways that you could do seller financing, again, depending on the seller. This is what I was mentioning earlier. So first is the seller owns the property outright. So they own it, they have no mortgage on it, they've paid it off completely, and they're selling it to you. Okay, so that's called a seller held first mortgage or first lien. Different states have different vernacular. But basically it's, where they have, just like a bank, they have a lien on the property until you pay it off. So why would a seller do that? And I'm not saying it's super common. It's actually not that common, but it's common enough that you need to know about it because you should always ask. All right. So their motivation would be the speed to close. Because the thing about when you're getting bank financing, you have to go through all sorts of hoops. You're jumping through lots of hoops, right? There's underwriting. There's going to be an appraisal. They're going to look at your personal financials. They're going to pull your credit. They're going to want to see leases if the property is leased. There's just lots of different things that have to go on. And it takes probably a good 45 days these days to close. So if the seller's willing to finance the deal, I mean, you could pretty much close as soon as you have got your title search done, and you would always get title insurance regardless. And you put your down payment. So from the seller's motivation, if they're in a situation where they need to get out quickly for whatever reason, it doesn't mean that, there's been a death or divorce. Like sometimes I'll tell you, I was in that situation when I was a new investor. It was actually my second deal. It was one, I wasn't trying to do a deal, but I was actually selling my personal residence. I wanted to move. I had an opportunity out of state to go move somewhere and start a company there. And I was like, I don't want to sit here and fix up my house for the next 2 months. I just want to move it quickly. So someone approached me and I was like, okay, sure. I'll hold the mortgage for you for whatever it was, like 90 days. And then you can fix it up and sell it. And then you could pay me off. Right. So for me, I wasn't behind in my payments. There was nothing wrong. I was just like, man, I have another opportunity. I want to get to it. So motivation would be speed to close. Sometimes it could be, well, in this case, if they own it outright, then it's not going to be because they're behind on their payments, but it could be a health issue that the seller themselves has a health issue. They can have a family member with a health issue. There's a lot of different things. They could have had a jobs transfer. And if you close right away and they don't have to worry about the property being there vacant or getting vandalized or anything like that, that might compel them to offer you seller financing. But sometimes they don't know about it. So sometimes you have to be the one to bring it up. The other reason that a seller might consider seller financing is the potential tax savings. So I'll give you an example. Well, actually, I'll get to that in just a second, and I'll tell you the tax savings. The other thing about seller financing is if someone is holding a first mortgage on the property, they're probably going to still require you to put a down payment. So if you're buying a property for, make it easy, $100,000 from a seller and they don't have a mortgage on it, they're probably still going to want you to have some kind of down payment. So, and the down payment can vary so drastically. They could say, oh, I want 50% down. They could say, I want 20. They could say, I want 10. Who knows? But it would be very unusual to have a seller who owns the property outright, who just sells it to you just for payments without you putting it down a down payment. So that's something to be aware of, which is why I said you still have a creative side where you got to raise the funds if you don't have it. All right, so let's talk about the potential tax savings. I'm going to give you an example of someone in our mastermind who is working on a deal right now. It's a 9-unit in Florida. And it's interesting because the seller has been trying to sell this property for a long time, but then COVID hit and he's operating it as a motel. So of course, going through that period of time, I'm sure his income went way down and he has multiple hotels in the same area. So he's also in his 70s and he's been managing it physically himself, personally, which we don't ever recommend because you become the burned out landlord who ends up selling your property at a big discount later. So, but our mastermind student was on the other end of that and she made him an offer and he wanted a much higher amount that she ended up getting it for. And she's like, I'm sorry, it just doesn't work at that. It needs a lot of renovation. I'm going to have to completely do a full turnaround on this thing. So anyway, it took weeks to negotiate it out, but they did. And one of the things that they negotiated was the seller is carrying their first mortgage. So she's putting a down payment. I want to say it was like 11 or 12%. It was fairly small as a percentage for commercial financing. Normally commercial financing, you're putting down at least 30%, if not 35 or 40%. So she was able to put down a much smaller amount of money to the seller. Now, why would the seller do that? Well, from the seller's standpoint, he's owned that property for 25 years. And he bought it for, now these are ballpark numbers. This is based on her conversation with me. Let's say he bought it for $300,000 25 years ago. Well, he's selling it for 1.6 million. So when he sells the property, he's going to get a monster tax bill from the IRS, just an absolute monster tax bill. And one of the things, the way that the IRS code is written, one of the things that you can do to stretch out and not get hit with that big tax burden all at once is you can accept seller financing. So the seller will only pay taxes on the portion he's received so far to date. Right. So each year he's going to get taxed on some portion, but he's not going to get, a single tax bill for, $300,000 or $400,000, which is probably what he'd otherwise end up getting. All right. So there's a lot of different reasons the seller might consider it. It doesn't mean they will, and there's nothing wrong with it. The seller says no. Oftentimes they just want their money out. But if you identify, hey, here's a win-win, I can help you get out quicker if you'll do seller financing, or hey, do you realize you're going to have a big tax bill if you allow me to make you payments instead of the bank, and you still offer them an interest rate, there's still terms. Like in this particular case with that 9 unit, it's interest only payments for 5 years. Although that's not, the seller really wants the payment. So he told her that she could not refinance for 3 years because he actually does want those interest only payments to come in for cash flow for him. So that's the other benefit to the seller is he gets cash flow. Anyway, so there's a lot of different things you should always ask the seller if they're willing to carry financing. All right, so another seller financing strategy is something called a subject to. The subject to is when the seller has an underlying mortgage, but if the subject to applies only if the seller is financing just the amount of the underlying mortgage. I realize it's probably confusing. So for example, let's say that purchase price is $100,000 and the mortgage is $100,000. Okay, what you can do is, as the buyer, you're basically just taking over the mortgage. So you're buying the property, quote unquote, subject to the existing financing. All right, so that's one thing. Let's say that the purchase price was $110,000, but there's a $100,000 mortgage. So in that case, you could still do a subject to deal. Would be you're buying it for $110,000. They're going to leave their mortgage that has a $100,000 balance in place, and you're going to give them the other $10,000. Okay, so that's why it says down payment. Maybe you might do a down payment. If you're buying the property for the amount that they owe, then there's no down payment. You just take it over, you close, you're done. But if they have, more equity, or you're buying it for more they have the mortgage for, and they're not going to finance that part of their equity, you're going to pay them out, then you would do a subject to. All right. Motivation, speed to close, same thing as before. Now, in this case, that's pretty much the only motivation is typically that, or if they're behind on their payments, it would be avoiding a foreclosure. A lot of times people will say, if they have any knowledge in this area, well, what about the due on sale clause? So every mortgage has this clause in it that says, if the property changes hands or changes ownership or anything like that, there's all these different things that could trigger the due on sale clause. And what the due on sale clause is that is the bank basically saying, okay, you've done X, Y, Z, that triggered this. We want our money for the whole house within 30 days. Okay, so that is the absolute reality. What we have to talk about here and be realistic about is what is the likelihood of them doing that? So let's say that you buy a property subject to the existing financing, you're sending in the payments every month, the bank finds out, oh, there's been a change of ownership. Are they really going to foreclose on the property? Because what situation is it going to put you in? You're going to have to refinance it, but what if you can't? Now all they did is add an REO property to their books. I used to be an accountant for a bank. I will tell you, they do not want more foreclosures on their books. It actually impacts them in hugely negative ways when they start getting outside of their allowable REO inventory compared to their deposits. So banks don't want to take back a property. It's something that happens when they don't really have any choice. So the due on sale clause is there and it's a reality, and you need to be aware of that and acknowledge it. But what are the chances of the bank saying, we're going to call the note due? It's very, very low. The only time where that was a little bit more of a risk, and it still didn't happen much, but back in the 80s, when the interest rates were exceptionally high and people had mortgages that weren't that high. Let's say somebody had a mortgage in place for 8%, but now the current mortgage rates are, let's say, 12%. A bank could say, oh, we're calling that note due for that 8% because they want to get that money back so they can lend it back out at 12. The problem is, and the problem remains, they could still basically end up with a foreclosure on their books. Now, that wasn't as big a problem back then, so maybe that's something they would have been okay with, but banks are super, super sensitive about that, especially since we had the 2008 crash. So yes, the due on sale clause is there. Yes, it's a possibility. Is a probability? Nope, very, very low risk. All right, so I wanted to just give you a visual about kind of what the subject to looks like. Okay, so you have the bank, all right, in the bank you have the mortgage, it's in the seller's name. Let's say the monthly payment is $1,000. In a subject to deal, the way it typically works is the investor is just making the payment directly to the bank, even though the mortgage is in the seller's name. So the seller ends up just kind of being out of the picture. Now, the risk to the seller is that the investor stops making the payment. Well, then it's on the seller's credit and it's going to end up being bad on their credit. So if you're ever talking to a seller directly, if they even think about that, you need to basically make sure that they know, like, look, I take it very seriously that you're trusting me with making the mortgage payment. I'm not going to not make your mortgage payment. And you just have to explain to them, like, well, first of all, I don't want to lose the house, but also I recognize that you've entrusted me with this, and I'll do whatever it takes. If there's some reason that it's short, I will go get a second job or do whatever I have to do to make sure that it's paid. I'm not going to let that happen. Okay. So just be aware that that's something that the seller might consider, like, well, wait a second, what if you don't make the payment 1 month? It's in the seller's name. It's their credit that goes bad. All right. So it's just something to be aware of. All right. The third kind of seller financing is something called a wraparound mortgage. All right. So a wraparound mortgage would be when the seller is going to finance more than what their mortgage is for. For example, let's say the purchase price is $150,000, and let's say that the seller is going to give you a mortgage for $130,000. They're going to let you finance $130,000. So you're going to put down a $20,000 down payment. You're going to pay the seller. You owe them $130,000. They owe the bank $100,000. Okay, so let's say that that's the case. So a wraparound mortgage is one where the seller is financing it for more than the other underlying mortgage. Okay, so there's probably going to be a down payment. So I say highly likely, but not always. Same thing, the motivation would be you can close very quickly. The benefit to the seller is that they can oftentimes get a higher price, because when a seller is willing to carry the financing and not make you go to the bank, it's very common that the buyer is willing to pay more because of that. Because, well, and oftentimes it's, someone that they can't get a bank loan anyway, or like us as investors, it's not easy for us to get a regular bank loan because we don't have W-2 jobs. We invest, we're entrepreneurs. So it's not as easy for us to get a loan as it is for someone who has a regular job. So from a seller standpoint, they can get a higher price because you have something that I want. You have financing and you're willing to offer it. Okay. Another benefit to them is monthly cash flow. All right. So I want to show you visually, there's two different ways this can work. All right. So the first one is, let's say that the monthly payment from the investor to the seller based on $130,000, let's say that that's $1,200. Okay. So every month the investor is sending $1,200 to the seller. All right. The seller has the mortgage, the underlying mortgage, they're still involved, and the seller's sending the $1,000 mortgage payment to the bank. Okay. So that is one way it can work. Obviously, as the investor, that's not my preference. And frankly, if the seller was still involved, I would actually insist that it be a third-party escrow company, because I don't want to take a chance of the seller not making the payment. Okay, so this is kind of more in theory. That little house above it, that could be the escrow company or title company. So I'd really be sending it to the seller, but I'm sending it to the title company on behalf of the seller. All right, and then let's say the seller or the escrow company sends the $1,000 to the bank, and then the difference, the $200, belongs to the seller. That's their cash flow. That's basically the interest that they're receiving on the loan that they made. Another way it can be done is the investor makes a payment directly to the bank for the $1,000 and then sends the seller a check for $200. So either of these is fine. My preference would be to do that, either send it directly to the bank or to send it to a third-party title company or escrow company, so I can make sure that I'm not having to trust the seller to send money in to the bank. Because obviously the risk there for me is that I send the money to the seller and, well, their car breaks down and they use the $1,000 to fix their car instead of making the mortgage payment on the house that I'm buying. All right, so those are some of the ways that you can do it. All right, so those are just the reason I wanted to spend a good chunk of time on seller financing is just because I know when most people sign up for a creative financing class, that's what they're wanting to know about, is like all the different seller financing stuff. So I wanted to explain those things, but I want you to understand that there's just so much more to it. And that's what a lot of times people aren't talking about, is what about the rest? There's always going to be a shortfall, either the down payment, closing costs, rehab, whatever. All right, so that's what I want to talk about next, is different ways that you can fund the shortfall when it comes to, even whether it's creative financing or regular financing, whether you're getting a loan from the bank or getting a loan from the hard money lender or getting seller financing. How are we going to fund the rest of it? All right. So one strategy, which is amazing and awesome, especially when you're just getting started, is partner up. Okay. And that's what I did when I was new. I didn't have funds to do my own deals. My first, I want to say 6 deals, I either partnered up with someone and I did all the work, they provided the money, or we did a private loan. So I want you to start thinking along those lines. And sometimes when people are just getting started, if they don't have the funds or they don't have enough funds, they get a little bit hung up on that, like, well, I don't want to give up half the deal. Look, it's the beginning. You have to sometimes be willing to do more than you'll have to do later in order to get your foot in the door and get things going. So it's okay for you to do a deal. If it makes sense and it helps to move your business forward, it's okay to partner up and split the deal with someone. It's a win-win. You make money, they make money, you get experience, which I'll tell you is infinitely more valuable than whatever money you're going to make, because with experience, you get to take that to every deal you do in the future. You have all this new knowledge and wisdom. And when you go to get loans later, the more deals you've done, the better lending terms you're going to get, the more that the lender will lend you, just period. Interest rates are lower, costs are lower. So partnering up is a great way to get started. But basically the way that works is the partner provides like the money, right? The partner provides the money, down payment and other costs, and you do everything. So your job is to make it as easy as possible for the partner. Well, for a couple of reasons. One, that's just how the arrangement is, but two, so that partner wants to do another deal with you. And if you don't have to worry about where the money's coming from, it's really easy for you to just be making offers, because you're not stressed out about, well, I'm making offers, but I don't know where the money's coming from. I always tell our students too, just make the offers, because certainly if you get something under contract, you're going to bust your butt to go find the money. And if you keep waiting to write an offer until you have all the money lined up, you're just going to never make the offer, because you never have enough, I don't want to say stress, but we'll call it stress, behind you to compel you to get it done. All right. So you're coordinating everything, make it as easy as possible for the partner. You're going to split the deal. And that doesn't mean it has to be 50-50. Splitting the deal just means there's some kind of split. So it could be 60-40, 50-50, 70-30, whatever makes sense based on what both parties are bringing to the table. Like maybe you're bringing some money, but not all the money. And you're doing all the work, or you're doing, 80% of the work and providing some of the money, and they're doing 20% of the work. So you just split it up based on what makes sense and what would make it a win for both parties. All right. And this type of transaction or partnering up is good whether if you're doing the BRRR strategy, buy and hold, or a fix and flip. You can partner up with someone on any of those strategies. All right. Another way to fund the shortfall is private loan. All right. So private lender. When I say private lender, I'm not talking about the type of lenders that are advertising on the internet. Oh, we have private money. Those are hard money lenders. When I say private lender, what I mean is your neighbor, your friend, someone you met at a networking group, another investor, just a person, an individual. That's what I mean when I'm talking about a private lender in this case. So typically it's going to be straight interest. Okay. So like it's not amortized, like where you would pay a bank. If you have a long-term rental property, you're typically having a bank and you're making a payment every month. And over the course of time, it's paying down the principal. Usually when you're borrowing money from a private lender, it's just straight interest. So if it's, 8% interest, that would be on an annual basis, then that's all it is. And it's interest only. So this is good if you're doing a private loan. This is good for the BRRRR strategy or fix and flip. Not so much for the long-term buy and hold, because you have to have like some way to be able to pay them back. And unless they're paying them out of the cash flow, I mean, cash flow would have to be pretty good for that to work. Doing a more transactional type of transaction is going to be a better fit. So fix and flip, obviously you're selling the property, you're getting funds in. For the BRRRR strategy, it's that last R, the refinance. And on Wednesday of this week, we're doing a full masterclass on the BRRRR strategy. So if you are new to the BRRRR strategy, or if you just want to learn more, Wednesday at 3 p.m. Pacific, we'll be doing that. But anyway, it's private lending is good for both of those. As far as the interest, there's a couple of different ways that you could do it. Like I said, it's usually straight interest, so it's not amortized. You can either do where you're paying, and this is always my preference. When I was doing real estate, when I was borrowing money for things for the transaction, I would always set it up with my private lender, and I would just tell them. I wouldn't ask them. I would just tell them, yeah, the way that it works is, you do the loan in the beginning, we do the project, and then when we refinance it or sell it, depending on what I was doing, we pay all of the interest back and your principal in one lump sum. Okay, but that's one option. The other option is to do monthly payments. So I'm not really a big fan of doing that because it then kind of crunches your cash flow potentially when you're in the middle of it. But you might come up with, or you might find a lender who just feels more comfortable getting monthly payments. If you do that, you just probably have to borrow more so that you have the capital to make those monthly payments. All right, but those are some options. All right, and then there's other resources, and I'm going to give you some ideas. So if you don't have a pen and paper, if you haven't been taking notes, get ready, because on the next slide we're going to go through some of those. But the other ways to fund the shortfall is just other resources, and those could be your resources or someone else's resources. All right, and that could be an interest rate that you pay them, or a percentage of the deal. Right, or you could combine your resources with someone else's. When I say resources, I mean, well, we'll get into it, but like it could be like, say, a home equity line of credit. Let's say you have a home equity line of credit. You can use that. You can use that to fund the shortfall. Let's say you don't have a line of credit, but your neighbor has a line of credit and he's super interested in real estate, doesn't really know how to do it, and you're the one willing to do the work. Well, then he can pull on his line of credit, and you can either pay him an interest rate. Let's say he's paying out 4% and you pay him 8%. Well, cool. He basically just made money on his HELOC, or you could give him a percentage of the deal if that made sense, or let's say you have some funds in your HELOC and he has some funds in his HELOC and you combine them together. The whole thing is to get creative. Sometimes you have to stack a few things on top of each other. All right, so here's some of the other resources that I want you to think about. One is a home equity line of credit, and with everything, always remember yours and someone else's. And there's lots of someone else's out there. Lots of other people, through networking, through the relationships you already have, through the relationships you can build over time. So home equity line of credit, business line of credit. Now, it might be a business line of credit for another business that you or they have. But let's say I have a business line of credit for my consulting firm. And let's say I have $50,000 available and I'm not using it. And say I just don't need it right now. I can make a loan from my consulting firm to a real estate company, which I happen to also control and own. I say it'd be the same terms as it would be for anyone else. I'm going to come up with an interest rate. There's going to be terms. There'll be a payment at the end with all of the interest, et cetera. All right. So it's sometimes thinking outside of your little real estate world, it starts to expand your mind as to what's possible. All right. Also a personal line of credit. So if you have a personal credit line with your bank or your credit union, anything like that can be used. Credit cards. Now, the thing with credit cards is there's not a ton of expenses that you can use credit card for. Although I'm going to give you some ideas, because there's been times where we've had 0% credit cards that I couldn't figure out any way to get the cash off of them, but I wanted to be able to take advantage of it. So I'm going to give you some ideas right now. With credit cards, here's some of the expenses that you can pay if you end up with a credit card that's got points or 0% or some other reason you'd want to use it. You can typically pay for your appraisal with the credit card. You can typically pay for the home inspection with the credit card. You can oftentimes pay for your rehab with the credit card. So a lot of contractors these days do take credit cards. And even if they don't, you can buy the supplies. So you could tell the contractor, well, look, go ahead and place the order for the supplies. I'll call in and pay for it. And you could use your credit card. So even if you don't, I'm going to teach you a trick in a minute too, but even if you just have a regular credit card, those are some of the things that you can pay to be able to use them. All right, now the 0% balance transfer trick. If you end up in a situation where you can qualify for, you know, a 0% credit card or a few 0% credit cards where they are 0% for 12 to 18 months. Usually you have to have pretty good credit to get it. All right, so let's say you get that. Most of those 0% credit cards have some kind of balance transfer promotion. All right, so they might not have a purchase promotion, but oftentimes they have a purchase promotion also. But they might have a balance transfer promotion where, you know, if you do a balance transfer within the first 45 days, or the first 60 days, there's usually some time frame that's just at the very beginning that if you do a balance transfer, then it will count for the 0%. You just pay your 3% balance transfer fee. Okay, so that's just the background. The trick is there are certain cards where, and we're not talking cash advance, because cash advance is never 0%. Cash advance is always like, you know, 20 something percent. But there's certain cards that if you call them and you say, I want to find out what my balance transfer options are. I'll give you an example, like Citi, C-I-T-I, and they have, Citi has like Citi Preferred, Citi Thank You, and Citi Simplified. I can't remember what it is, but anyway, the Citi cards. If you call one of them, you get one of their 0% cards, you call them and say, I want to do a balance transfer. And they say, okay, which card do you want to transfer to? You can say, actually, can you just send a check to, mail me a check? And they'll say, okay. I know it's crazy, but it's also true. I've helped a lot of my students do this over the years. All right, so if they say, yes, okay, what they'll do is they'll then send you a check for whatever the cash advance amount is, not cash advance, whatever the balance transfer is, they'll mail you a check and then you go deposit it in your account. And now you've essentially liquidated that card. Now you are going to have a payment every month. So this is something that you don't do it lightly. You have to plan everything. You're still going to have a payment of probably about 1% of the balance each month, but it's at 0% interest. So every month you're making a payment, all you're just doing is paying down the balance. And then the balance transfer fees do apply. Discover is another one where you can call them and say, can you send me like a convenience check? They're probably going to ask you, well, what is it for? Just tell them business expenses. Okay. And then they send you a check, you write it out to yourself or your company, you deposit it, and it's basically treated like a balance transfer. So not all cards, like I want to say Chase, the couple Chase cards that I looked at did not have a balance transfer one. So you have to actually read that page that has like the big grid and has like whatever the percentages to make sure that you're doing this with the right cards. But that is a way that you can essentially use a credit card. It's usually a new one though, to get additional capital to do the deal. And you just want to make sure that the terms are something that it makes sense that you could pay it off by that time. Or if there is going to be interest, that you have enough funds coming in that it's okay for you to continue to pay it back. Okay, but that's a cool trick that I realize a lot of people don't know. And I spent a lot of money to learn how to do that. And I was like, wow, this really does work. But always go and look, and you should always ask. Like I want to say Wells Fargo and Bank of America cards, these weren't me, but these are some of my students. We just called and asked the question like, hey, do you have the option for balance transfer of just sending me a check? And I can't remember which was which, but one said, no, but we could do a direct deposit into your account. Okay, and that was just for the balance transfer, thing, and they charge the balance transfer fee. But basically what it ends up being is you got access to that capital for 3% instead of whatever normal, credit card interest rate you'd pay. So that's kind of a cool little trick. And also keep in mind, if you know someone else that's got really good credit, they want to get involved in real estate, they want to make some money on a deal, you could always go in and help them apply for 0% credit cards and then walk them through the same thing that I'm teaching you. All right, another resource is self-directed IRA. So a lot of times people have funds that are in a retirement account from a previous employer, and they're just sitting there either doing nothing or sitting in the stock market. They're not making the returns that they want, or they're nervous about the stock market. They can roll those funds into a self-directed IRA. The self-directed IRA is specifically for assets that are not like conventional retirement assets. So no stocks and bonds and things like that, but you could definitely buy real estate with it. So self-directed IRA isn't really going to be an ideal situation for you necessarily, because your lender is probably going to require a personal guarantee, which means you could not use your own self-directed IRA. We have a whole actually interview with a self-directed IRA owner of a company where we get into all of that. So that's something we have for you if you want to learn more about that. But where self-directed IRA really, really, really comes in handy, and I used a lot when I was new, is other people who are not in real estate, but they have those funds, is getting them set up with a self-directed IRA, and you can help facilitate that. And then they can, their self-directed IRA can loan you funds for your real estate deal for whatever the percentage is. And when you pay them back, the money all goes right back into their IRA. So it's a way for them to build up their IRA and get a really nice solid interest rate on it as well. So that's another possibility. You can also have someone self-directed IRA partner with you. So if it's a situation where you need a partner in a deal, as long as the person doesn't have to sign on anything, you can sign on everything, but the funds come from their IRA, you can partner with someone's IRA. So that's another possibility. A couple other resources, I haven't done either of these, but I am aware. So just in case they apply to you, I wanted to mention them. Cash value of a life insurance policy. So if you have a life insurance policy that has cash value, you can always pull that and borrow against that. Also, if you have a stock portfolio, depending on where you are holding your securities, and depending on the size of your account, a lot of times you can borrow against your stock portfolio. And this is actually something that has come up for me when dealing with other people who are partnering with me or we're doing private loans, is them borrowing against their stock portfolio to make the loan. They're basically paying themselves like some very small interest rate. I'm paying them a much higher interest rate. So personally, they're ending up making the interest on it. So that's kind of cool. Anyway, so these are just some of the other resources that are out there. And I'm going to give you an example real quickly of when I was doing my very, very first deal. This is where creative financing really like hit me hard. Like, okay, yeah, this is going to be a part of my life forever. My very first deal, I did not know what I was doing. I mean, at all. I was so green, it wasn't even funny. And I was buying a fix and flip, and I was getting a loan for 90% of the purchase price because I had a mortgage broker, and he must have been presenting it like it was a rental loan or something. Anyway, I got 90% of the purchase price, and the house needed cosmetic fix up. So it wasn't horrible, but it needed cosmetic fix up. So I had to put down 10%, the down payment, and I had to fund the renovations out of pocket and closing costs and financing costs. So when I was going through and trying to figure out how to piece this all together, I didn't have my own funds. I borrowed the 10% down payment from a private lender. And so I had that part, but that was all that they had available. And I had to fund the rehab and the closing costs and everything else. So I had a couple of credit cards, and I ended up connecting with a friend of mine. Her husband was more than a handyman, but he wasn't a licensed general contractor. Now I only use licensed general contractors at this point in my business, but back then I didn't really know that yet. So I had just gone to him and said, hey, Alex, so would you be willing to do this project with me if I'll pay for all the materials because I can put them on my credit card, right? But instead of the labor, let's say the labor was going to be $10,000. I don't remember the specifics, but let's say the labor was going to be $10,000 for him to basically get all this stuff done. I said, I'll give you $15,000 at the time of the sale, like once I sell the property, if you'd be willing to basically not take payment during the project. So I don't have to go figure out where to go find another $10,000. So basically I gave him, now I look back, I'm like, that was probably a little bit extreme, but I basically gave him an extra $5,000 as a way of financing my rehab. And so it was really a matter of putting it together. I had 2 or 3 different credit cards. I had a private investor, I had a bank, and then I had my contractor be willing to finance the rehab in a creative way so that we could put it all together. And that's really what more creative financing is. It's pulling all the pieces together to make it work. Anyway, I hope that you guys found that helpful. If you're new to our group, or if you haven't really been around before, if you feel like you need some help with getting started, feel free to I wrote our business cell phone number down there. Or if you're looking to scale your real estate investing, go to the next level, just text that number that's on the screen, 619-373-8461. And you just text the word freedom, and we have it automatically set up that it will shoot you a link to the application for the mastermind. So if that's something you feel would benefit you or that you need some help with, then feel free to do that. And what I'm going to do for those of you who have questions is I'm going to bring you guys over. Oops, my camera's off. Let's fix that. Oh, there we go. It was so weird presenting when I can't even see myself just doing it in PowerPoint. I don't know if I'm a big fan of that. All right, let's do that. I'm going to bring you guys over, and if you have questions, this would be the time to ask them. So be patient. Give me a minute. I'm going to promote all of you to panelists. When you come over, if you can turn your video on, that would be great. So I don't just feel like I'm talking to myself. All right. promote. Look at all these promotions. Promotions to panelists that are happening. All right. And you guys are welcome to ask any questions that you can think of. It doesn't have to necessarily be on this topic. I probably can answer pretty much most questions if it's related to anything related to real estate. And if not, then I'll find a resource for you. All right, can you guys all over? Go ahead and turn on your video cameras. Ooh, we're getting there. Oh, baby. Oh, Aaron. All right. All right, guys, thanks for being patient. It's a very manual process. Almost there. Okay, and oh, Aaron. Awesome. There we go. Okay, very good. Okay, are there any questions that you guys have? I see so many people without your cameras on. You guys turn on your cameras. Don't make me just look at your names. Hi, Carolyn. Go ahead. What's your question?
Stacy?
Good. How are you?
I'm good. It's good to see you. So this is so silly, but I'm asking it with courage, right?
Oh, yeah. Please do. It's so much silly.
Right. So when I think, what do I want to earn if I'm investing in somebody else's project? I say, well, gosh, the stock market makes 7. So I want at least twice that. That puts me at 14, and then I round up to 20. So I that's what I ask for, right? It's so wonky, right? That's not a process. That's not a formula. How do you figure out what is fair to ask for and or give in terms of a percentage back or a rate back?
Gotcha. Well, so it's hard for me to answer what is it fair to ask back, because that's just going to be based on what you personally want. So I'm more comfortable answering it from the other side. And that always is going to be, which again, you're seeing what it's like to be on the other side of this question is, well, what is something that would make you excited? So if someone has the expectation that, well, I know if I put money in the stock market, I'm going to get, 6 to 8%, I'd be happy if it was secure 8% or 10%. I've had someone who said, well, I mean, as long as you can pay me what I'm already getting, 4%, I'm happy. And I'm like, okay. So yeah, so the thing is that from a strategic standpoint, it's always smart to ask the person so that you can come up with a win for them. Now, if someone says they want a 20% interest rate from me, I would say kick rocks, because I'm not going to pay that. But I don't know that would be true when I was brand new. But also, if it's so much that it makes it that it's not a deal or it's not a win for them, then they wouldn't do it. So it's easier for me to say if you're talking to someone else, but you're talking to someone else that doesn't know how to do real estate. They don't know how to do any of this. And so they're like, wow, I could get into real estate and I can make some interest and kind of like be a part of it. Cool.
And I don't have to do anything. That's the other part. You're doing all the work. So, why am I giving away all of this big amount? So like if you take the stock market and just say, okay, if the stock market generally pays 7 to 8, I'm going to start you in between 10 and 12 and put your head in there in terms of where you start your negotiations. Does that seem reasonable, or would you laugh?
That is very reasonable. When I was brand new, I obviously would do things differently now that I know more, but when I was brand new and didn't know I didn't even know what hard money was, I would go to the investor clubs, but I had taken like some classes. They were horrible. Like the education was terrible, but I knew enough and I was super enthusiastic, right? So I was like, okay, so yeah, you want to do real estate? I'm doing real estate, which I was still trying to do real estate, right? But yeah, if you want to learn real estate, I'll totally teach you everything that I'm doing. And I meant it, because I'm a natural teacher. I want to teach everyone anything I know. Like, I'll teach you what I'm doing. You could be my lender and I'll do all the work, and then I'll pay you 2 points and 12% interest. And they're like, no, that sounds good. And then they'd be like, well, what's a point? So that I don't recommend. Don't offer points, because that's what hard money lenders would ask for. But as far as interest, I don't even say a number anymore. I just say, what would be a win to you? Because sometimes they'll just answer you. So instead of them saying, well, I get 7 to 8% now, I'll say, okay, well, what would be a good number for you? Because they might just say, oh God, that'd be great if I could get 8%, but I knew I was getting 8%. With the stock market, you don't know anything. There's nothing you know.
Right.
You might make 5%, you might make negative, and you might make 12. Like, you just don't know. So if you can present it like it's a secure 8%, secured by the deal, and if they say, well, I'm making 7 to 8 right now, a 10 would be really great, or 12, then start the conversation. I wouldn't even plant anything. Just ask them. Like, well, what are you making now? Yeah. But as far as what you expect, it has to be something that's a win for you. And if you know real estate, that's a different standpoint than kind of what the person I'm talking about as your ideal lender is usually someone that they love the idea of it. They have no idea how to do it.
Right.
So it's a little bit different situation.
That's great. Thank you.
You're welcome. My pleasure. All right. Who else has a question I can answer? Well, Erin, I see that you're not muted. So I don't know if that means you have a question or you just happen to not be muted.
Oh, I just happen to not be muted.
Okay.
I got to talk all the time. Sorry.
That's all good.
I miss you.
Miss you too. It's glad to see your name on there. And I was like, oh, Erin.
I have a follow-on question if other people think
Sure.
that's interesting. So, okay, so say you give that person, your investor is coming in, you say, great, I'm going to give you 10%. It's a guaranteed 10%. And then your whole project flips and you're like, shit, how am I going to come up with that 10%? And I'm sorry if you've been in that situation. I have been in that situation now, and it's tricky, man. It's really tricky. How do you negotiate out of that other than just beating your vendors, right?
Well, in a situation like that, so the question is, if you're in a situation where you've guaranteed someone 10%, but now you didn't make the profit that you thought, and so you don't have it, you have to come up with payment arrangements for them.
Okay.
Yeah, and it doesn't. And maybe you're not going to be able to pay it all back the time that you thought. It's just a matter of being like, look.
Yeah.
I am a firm believer that when you are open with communication and you're like, look, here's what happened, here's what I did about it, and here's where we're at right now. I want to make good on it. And then just coming up with a plan to make that happen. And maybe you guys agree, how about we have the interest like stop accruing like now, but let me make payments to you. And then you handle it. And that's unfortunate, but it's just like a matter of maybe you end up with another deal and you take some of the profit and you pay them with it.
So in some regards, it's, if you put somebody in as a percentage ownership in that JV LLC, then they're taking the risk of ownership of the JV LLC in that position. And so the loss is something that they would recognize as a risk going in, as opposed to a guaranteed position where you would feel that obligation to pay them back.
There's really two different things going on. One is, and so in there I said partner up as one and borrow the money as another. When you borrow the money, you are saying, it doesn't matter how the deal does. If you make a whole bunch of extra money, they don't get any part of it. If you make less money, they don't make any less. It's just a loan.
Right.
It's like a credit card. You pay it back. Doesn't matter what you use it for, how much you make or don't make. It's just a loan. If someone's partnering and you make more money, you both benefit. If the deal makes less money, then you both make less money. It's whatever it was agreed upon. But in a joint ownership situation, it's both people are sharing the risks and the rewards. In a lender situation, if you make more money on the deal, that private lender doesn't make any more, you get all of it. But that's why they are getting like a set interest rate, right. A guaranteed, the guarantee is not that the deal guarantees it, it's that you as a person are saying, I'm borrowing this money for my deal, but I will pay you back. And if something happens and the deal doesn't go the way you think, or something drags on, which, I've had that before too. I had a rehab that went, because of very, very weird circumstances, lots of weather issues, went way longer than I ever would have dreamed. And I just had to be in very good communication with my lender. I did not hide. I did not clam down. I was just like, hey, I'm just letting you know, here's the situation. The contractor got cancer. We gotta get a new contractor. Okay, now there has been monsoons and we can't do the trench. And so we can't start the project. So I was always just in really good communication. And anytime I've ever done that, the response has always been from them, wow, that really sucks. Thank you so much for just letting me know.
Yeah.
Never, how could you? It's never like that. And if they did, I would just be like, well, I'm sorry. I think you're just insane, but cool. But it's never been that. They've just always appreciated the forthcoming communication and always like, I'm just letting you know what's happening. And here's
that's where I am now. We're at a year on a rehab and I've got COVID and I've got fires. So I'm like, really?
Yeah, just being in communication.
I'm sending out a communication every 2 weeks, right? this is, this is the status now. This is what's happened. This is the status. So,
And you might, if there's other people involved, you might want to ask them if every 2 weeks is okay for them.
yeah.
Because it's especially if they have money in the deal and it's all this uncertainty that could, depending on what those funds were for, that could create a lot of angst. And by you just communicating or over communicating, it might just help them know that you at least aren't like bowing out and being like, oh,
too bad for you.
Yeah, they know that you're staying in it.
Right.
And that's important. It's important from an integrity standpoint.
Thank you.
You're welcome. My pleasure. All right. Do we have any other questions today before we wrap up? No?
Yes, I do have a question.
Oh, yes.
So about self-directed IRA, can you kind of, tell me what are the steps exactly to get into that? What are the risks? Because I've heard like lots about, if you don't do it right, tax, you might lose a lot of money. And if you don't do it right, so it's just, if you kind of lay down the steps, I appreciate that.
Sure. Well, there's not really, the first thing you have to do is are you talking about for your own self-directed IRA? Or
yes.
Someone else's? Okay. So the first thing you want to do is you want to have your funds be rolled over to an actual self-directed IRA company. Like UDirect IRA is a self-directed IRA company. There's Equity Trust is a company that does just that. So there's really not much to it. There's really nothing that you can screw up there. You just contact them. They give you the form, you fill it out, and they help you initiate the rollover. The things that you can do that could potentially screw up your like your status with the IRS would be if you took those funds and, for example, let's say that you took $50,000 out of your bank account and took $100,000 out of your IRA and you went and did a deal with that $150,000, that's considered prohibited transaction. So if you do something like that, well, first of all, the IRS would have to find out, but that is the type of thing that would flag your IRA. But the self-directed IRA companies are at least UDirect IRA, no, because they're mine. They ask a lot of questions up front, and they will deny transactions if they're like, you know what, we're not going to do that because we feel like it could appear this way to the IRS, and so we're not going to do it. And you might be like, but it's my money. They won't do it. So it's almost like they don't take the responsibility of protecting you. They'll never say, oh yeah, we protect you. But the reality is they ask a lot of questions. You got to fill out forms, like everything is documented. And if they see you doing something that is going to be a prohibited transaction, they'll let you know, no, and they just won't do it. They won't release your funds. So you can it's almost like you can use them in a consultation before you're doing a deal and say, hey, this is what I had in mind. Is that something I could do? And Farida, are you in our Facebook group?
Yes, I am.
Okay. So if you, actually I have to go and do the new member post today, but I just did one on Thursday. If in any of the new member posts, if you say self-directed IRA, Gazel will send you a link to an interview that I did with Karen Hall, who's the owner of UDirect IRA. And part of the reason I have that available is because it was so packed full of information about prohibited transactions, what you can do, how does it work. It was really, really good. So I saved that interview and I make it available when people are, looking at that, just so that you have more of an understanding of how you can benefit from it.
Thank you so much.
Yeah, no problem. My pleasure. All right. Any other questions? All right. Well, it has been my pleasure to spend this time with you guys today. Again, if you are not registered for Wednesday's webinar on the BRRRR strategy, but you would like to learn more about it, we'll be here Wednesday, 3 p.m. Pacific. And I will see you guys then. Have an awesome, amazing day, guys. Bye.
Bye.